Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, National Underwriter for Old Capital, Paul Peebles, and joining me today is James Eng. James just joined us from GE Capital, so he has a very extensive background in finance, and we're going to learn a little bit stuff today with James so he can help you finance the transaction. So James, how are you?
Good. Thanks for having me, Paul.
No, thanks for joining Old Capital. We appreciate you sitting in on the podcast today and see if we can educate some people about finance and how to structure transactions. So James has a very interesting background. He came from GE Capital, which is probably the largest provider of finance, of real estate, really in the world. And
right.
So when he came to Old Capital, he brought a series of skills, and hopefully those skills are definitely going to help you out in financing your next property. So one of the ways that we finance properties, besides a portfolio loan, like a bank loan from Grandma's deposits are providing the bank loans that can help you finance an office building or retail or warehouse. Another way is with Fannie Mae or even Freddie Mac or FHA. But the last way, and one of the things we like to do, is through a CMBS platform, a CMBS. And I want to talk a little bit with James to have him explain to you a little bit of what CMBS means and where it fits into financing and how that works. And so we're going to have a little bit of a conversation today with James about what's going on, how that works, and what the advantages and disadvantages of what a CMBS. So let's kind of start off again. James, what is CMBS and what does that mean to a typical person?
Sure. CMBS stands for Commercial Mortgage-Backed Security. And so what it is a loan that is backed by an income-producing property, and the mortgage-backed security comes into play where banks will originate the loan, then they will pull these loans together and securitize them into individual tranches in which investors then buy into. So instead of one bank taking the risk on one loan, investors are able to buy a tranche of many different properties across the United States against different property types. So it's giving owners the lowest rates, as this is the most capital efficient, or one of the most capital efficient ways of securing financing.
So let's think of it in terms of this way. And mostly CMBS transactions are $5 million and above. So $5 million and above. Some banks, that's a lot of money to put into a loan for any one investor. So how I like to try to explain what a CMBS is, it's like one loan that's thrown into a pool, just like your pool in your backyard. Let's say it's a 10,000-gallon pool, and one of the drops is this loan that goes into the pool. And then an investor comes in and gets a big bucket and takes out a big bucket of money. And the investor is the one that puts it in your 401k or your IRA. It's the kind of the fixed rate portion that the investor is looking for. So it's the money that the investor has to use. They have stocks, bonds, and cash. So it's the bonds. It's the fixed rate portion. And so the investor takes an interest, a small interest in your real estate investment. So instead of one big lender, it's a series of smaller investors buying pieces of your deal. And so it's been around since the late 80s, early 90s. It's part of what's called securitization program, and it's a way for larger properties to get financed. So I think that's probably a good way of explaining to you. So tell us a little bit about the process, James, on a CMBS loan.
Sure. There's about 35 different conduits, you could call them, in terms of banks out there who are willing to originate these CMBS loans. And once they originate it and close it, they then put it together with a large pool of other banks' loans, and they're able to securitize these out to the market. And so let's take, for example, Bank A might put in $200 million, another bank might put in $500 or $600 million, and now you have an $800 million securitization that goes to the market. And from there, credit agencies such as Moody's and S&P will rate different tranches based on the risk they see in these transactions. And investors can come in and buy these different tranches and get a yield or spread above, say, the treasury at the time. So if there's a AAA tranche that's rated, 100 basis points over the 10-year treasury, then that's where a lot of people can play, and a lot of investors will buy that tranche and earn that spread over just the typical government security.
So that's the fine print in CMBS and how it works. So, but now let's talk about the advantages and the disadvantages, and then underwriting the transaction. So one of the things that I want to have everybody understand is, again, why people want to do this type of a transaction. So let's just use a typical $5 million multifamily, or a $5 million warehouse, or a $5 million retail center. James, kind of walk with me and tell me a little bit about underwriting the transaction. What are you looking for?
Sure. In CMBS, you're really looking to finance stabilized properties. So 80, 90% occupied properties with a strong trailing 12 and in-place rent roll that will support the debt. So CMBS lenders are not looking at future rent increases or future CapEx, any of that, in terms of they're looking at stabilized operations. And so they're going to size the transaction on the trailing 12. And so your NOI, typically, they'll look at a debt yield, which is your net cash flow over your loan amount. And from there, be able to size the transaction based off of that.
So this is not a value-added lender. This is definitely not somebody where it's an acquisition with rehab.
Right. So they're going to look at the last 12 months in terms of expenses and in terms of revenue as well, and maybe go to a T6 annualized, but it's going to be based off historicals and not future revenue.
Let's talk about different product types. Let's give me an example when you guys are underwriting a transaction and it's office or it's retail. What are some of the drivers of what you're looking for to make that loan happen?
So in office and retail, you're going to need, these are long-term loans. So these are 5, 7, 10-year loans, and there's going to be turnover or rollover in the office and retail assets. So a lot of times we will forecast the rollover and predict the tenant improvements and leasing commissions. And from there, we'll take an average across the 10, 12 years that the loan is outstanding and make you hold that back in terms of a reserve. It could be every month or every quarter in terms of cash flow.
So a rollover, what does that mean?
Rollover. So typically in apartments, there's turnover in units. So rollover is more if there's a 3-year lease to a large credit tenant or just a regular tenant. After 3 years, there might be some downtime, and then there might be some tenant improvements or leasing commissions if that tenant leaves.
And what is a large credit tenant? Is that a nail salon?
So in terms of credit, you will get better pricing and better value from a tenant that has a credit rating of BBB or higher. So anybody really on, say, the Fortune 50, Fortune 100, the larger companies that have solid cash flows that are rated by the agencies, you will get a stronger rents and also better terms on your loan with credit tenants.
So better pricing of the spread. So if we did a LIBOR or a 10-year treasury, the spread, which is a profit margin for the investor, if they had credit tenant leases that were in place, that you would probably get a better price, better interest rate on that loan. Is that right?
That's right. So
really what you're trying to do is on these transactions is really find somebody that is a credit tenant lease. Again, give me 3 or 4 names of credit tenant leases.
Sure. Here in Dallas, any of your sort of major, ExxonMobil or Kimberly-Clark, Procter & Gamble, your larger companies that have established operations that have been around for a long time, that people trust the company, that they're going to be here for a long time going forward.
And what's your take on people that are non-credit tenant lease or tenants that are not as strong? And I'm not talking about the nail salon or the little jewelry store, But I'm talking about kind of the middle markets guys still that are not in NASDAQ or the New York Stock Exchange are not rated. You can still do those type of transactions, right?
Definitely. On CMBS, we're looking mostly at multi-tenant properties. So we're going to look at the overall occupancy, and then really we're going to still predict a 50 to 65% renewal probability for these tenants. But if there's been a history of either delinquency of a tenant, or if the tenant is within 6 months of their lease expiration or their month to month, then that tenant won't be counted in your calculation for NOI. So you want to make sure that you have long-term leases at these places. They want to see stabilized historical cash flows from these tenants. And we'll look at the credit of these overall tenants before making a decision on a loan.
Is single tenant a good choice for CMBS?
Single tenant is a possibility, but it's going to have to be a strong credit. So, say a Walgreens or CVS, and the location is still going to play a factor on these deals. And a lot of times, to get to that $5 million minimum, we're going to possibly need a portfolio of smaller CVSs or Walgreens to get it done.
Now, you've been an underwriter for 10, 11 years with your past company. Now you're coming to Old Capital. So now instead of just offering one product type that you had in the past, now you're able to offer multiple product types and multiple mortgage bankers that offer the CMBS platform. I bet that's more exciting to you than just being able to be a one-trick pony. Is that correct?
Absolutely. There's over 35, 40 CMBS lenders in the market, and all of them have different risk tolerances and how much risk they want to take on to hold the loan on their balance sheet before it securitizes. So there's typically 60 to 90-day window when that bank has to hold it on its balance sheet before it moves to securitization. So different risk officers at those 40 different conduits are going to have different ideas on what type of risk they want to take.
Would you consider yourself an expert in this field?
Absolutely. I mean, doing it for 10 years, you see a lot of deals, you see a lot of transactions, and being able to not only underwrite transactions but get them approved through a pretty conservative bank. I know how to look at credit, look at tenants, look at markets, look at rollover risk, and be able to help you size up a transaction either before you're under contract or even while you're in contract. And
hiring James is definitely an advantage for you in the competitive marketplace, having an expert that is behind you to make sure that you're doing the right thing. So I understand that. Tell us a little bit more about CMBS and talk a little bit about the advantages and maybe some of these disadvantages with the CMBS. And let's kind of make this a broad question piece.
Sure. So, I mean, first thing, CMBS will be non-recourse. So that's a big thing for a lot of borrowers out there. So non-recourse, 75% LTV, 30-year amortization is typical on CMBS. And one of the nice things about CMBS is that you're able to use it as a cash-out refinance and lock in long-term rates. So most of the time, the rates are fixed for 5, 7, 10 years, depending on your term. And right now, rates on a 10-year are hovering around 5%. So in terms of advantage, you're locking in a long rate and or long-term at a fixed rate.
So where multifamily has Fannie and Freddie as a backstop, the banks have only grandma's money that they're using on the depository piece. But banks only want to do maybe a 5-year or a 7-year term. I mean, they're risking grandma's money on interest rate risk, so they don't want to go too far out. And they definitely, they don't want to go out 30-year amortizations, and they don't definitely want to go out 10-year terms, and they definitely don't want to do a non-recourse piece. So the advantages with the CMBS gives you the ability to really get a permanent loan in place. A 10-year term, 30-year amortization, it's a permanent loan solution for warehouses and office and retail and multifamily. And let's talk about some of the disadvantages with CMBS.
Right, yeah. So CMBS is really set it and forget it. And in terms of disadvantages, some things you want to keep in mind are the bank that you're going to work with they're not going to have that much flexibility on the structure of the loan. So they're going to have to securitize it. So in terms of loan structure and loan agreement, those are going to be pretty boilerplate. When you get them, that's the template. There's not going to be much modification, because if there are any major changes, the bank's going to have a rep that there was a significant change, and that's going to stick out like a sore thumb on when it goes to securitization. So your bank is not going to want to have any major changes on your loan structure. Another thing is on prepayment. So typically you'll be locked out of a CMBS loan for typically 2 years after it securitizes. And then there'll be a prepayment penalty called defeasance if you prepay it before the last 3 to 6 months of the maturity. So loan structure, prepayment, and then also in terms of loan servicing, not all of your CMBS originators service their loans on the back end. So the guy you worked with on the origination might not be the guy you work with 2-3 years down the road. It's going to go into a master servicer, and that person is going to follow the letter of the law in the loan agreement. So there's not going to be much negotiation. If it wasn't described upfront and detailed in the loan agreement, it's not going to happen.
And these loans are assumable, right?
These loans are assumable, right? So there'll be a 1% assumption fee, and you'll work through the master servicer to do that.
So let's go back to that defeasance piece, because I think that's important, because that's like a prepayment penalty in this transaction. And why it's important, why we mentioned about the assumption, is that you don't want to pay this loan off. Sometimes there's a lockout, whether it's 1 or 2 years in a lockout, which means that you cannot change anything. You just have to keep going. And then after the first or the second year, whatever it says in your documents, then you're able to have somebody come in and assume the loan. But for some reason that you needed to have somebody, that person wouldn't want to assume and you had to pay it off, there's a thing called defeasance. And James, tell us a little bit about defeasance and how that works and some of the costs on that.
Sure. Defeasance is really a substitution of collateral, right? So you are pledging new collateral in return for releasing your property out of the CMBS securitization. So typically these are government securities. So they're going to want to match your payment that you've been making to the securitization with a government security. So depending on the rate that you locked in at, so say you locked in at 5%, but now rates have increased or decreased, that will determine the amount of defeasance that you will have to pay on your loan.
We have to know that at the end, is that if you are coming against a prepayment penalty or a defeasance, there's going to be some additional costs if that's what's going to happen. Is that this is a good loan program, James, for a refinance?
Definitely. Especially a lot of people that we work with, maybe they're coming out of a construction loan or a recourse loan where they've done a lot of value add, and now they're wanting to hold the asset for a long period of time. Then CMBS is a good execution. They're able to put 75% non-recourse debt, fix the rate for 10 years, and just set it and forget it.
Well, I like that phrase, set it and forget it, because it really is. It's a permanent loan piece. You don't use it for a bridge loan. It's for the person that's going to be in this property for a long period of time and looking for a permanent solution for financing. So we do a lot of CMBS transactions. James is, as he said, and I'll say it, James is an expert. You do definitely want him on your team. Now, James, if the transaction is lower than $5 million, do you have some options and solutions too?
Definitely. We work with multiple lenders that are able to do these transactions. Typically, they need to be, the minimum is above $1 million. Between that $1 to $5 million range, we definitely have lenders who are ready to step in and support you on a CMBS product. So let us know if there's anything that you come across that would fit this product. And if you want to run it by us, definitely give us a call.
So let's make sure that everybody understands who you are again. Can you give me your email address, James Eng, and can you also give us your telephone number?
Sure. My email is jeng@oldcapitallending.com, and my phone number is 214-300-5035.
All right, James, thanks for spending some time in the podcast.
Thanks, Paul.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.